Sweet. Well, I got a few people in the background that are going to stay muted, and some people are driving. So I'm going to go ahead and dive in. And just so everybody knows, this is being recorded. This is not intended as financial advice. This is intended for education, to teach you how life insurance can be set up and used as an asset while you're alive. So before you make any financial decisions, make sure you reach out to a licensed professional to go over your unique needs, whether that's a financial question, an investment question, or a tax question. What we're going to talk about is just some broad ideas today on how to set up life insurance the correct way so that you could utilize it more than just as a death benefit. So that's my disclaimer for the afternoon. I'm going to go ahead and assume that most people understand this is going to be part of a course that I'm creating. So the course is all about how to set up cash flow banking using life insurance. And so this is going to be part 2 of that course. And I figured, you know what, I'm going to be teaching this. Might as well just get some people on here. If you have any questions as I go along, just feel free to type something in the chat window, and we'll make sure to get to any of the questions later on. So by the time you've gotten to this point in the course, you would have seen me talk about how interest rates work, amortized loan versus compounding interest, types of assets that you can borrow against. And so when it comes to life insurance, a lot of people think life insurance is just about a death benefit. There's a lot of benefits to life insurance that you can actually get while you're alive. And to me, the reason I love it so much is that I never have to apologize to a client for their account value going down. Too many people take unnecessary risk in the market every single day. In my opinion, it's unnecessary. Now, do I want to be able to take risk with my money? Sure, of course, sometimes, but calculated risk. And the idea of keeping money in an account that can go up and down for the rest of my life, hoping that I get to some retirement age, like 60 years old, hoping the market goes up, hoping tax rates go down, and then I'm subject to whatever that account value is when I'm 60 years old. So I'm giving up the control, use, and liquidity of that money if I just follow traditional planning. So life insurance can be an asset. It's never really intended to be like a one and done or just set it and forget it. Life insurance can be a phenomenal asset for entrepreneurial minded people who love their family and hate paying extra taxes. So the idea of life insurance as a tool is much more attractive than just buying a death benefit. So I'm going to go ahead and share my screen. Again, if you guys have any questions, just go ahead and type it in the chat. All right, let's talk about life insurance. The amazing value of life insurance. I tell you, when I was a kid, I never thought that I would be doing this as a career. I thought I was going to be an architect. And if you would have asked me at 18 years old if I would be helping people understand life insurance, I would have said there's no way. Why I fell in love with it is because of how I can use it as a entrepreneurial minded person that wants to leverage cash. So for real estate, for example, it's a great idea. I can use the bank's money to go buy real estate. That's exactly how life insurance is set up. So when I buy life insurance, I have what's called a premium. And the premium represents how much money I'm going to put into the policy. So let's say I want to buy a $2.5 million death benefit, and I'm 40 years old. Okay, there's a ton of different ways to buy insurance. And if you listen to some financial entertainers, they talk about buy term insurance and then invest the difference. Yes, that is a good way to do it. It's not the only way to do it. So if I need a $2.5 million death benefit and I'm a healthy 40-year-old, this is just an example. So all of these numbers are going to be based on age, health, and sex. So men and women are different because at the end of the day, we're buying life insurance. So I want to put a $2.5 million face amount or death benefit in force. There's a number of ways that I can pay for this. So let me give you an example. Let's say I want to put $10,000 a year. This is going to what's called the base of the contract. The base of the contract buys death benefit. Okay. This is how the advisor will get paid. They get paid commission on the base portion of your insurance. So in this example, the base is $10,000. And that's going to buy a big death benefit. Inside the tax code and how you can design life insurance, there's other ways to fund this. So if I want to put extra money in, I can put what's called paid up additions. Paid up addition is basically paid up additional death benefit. And the part that's fun is this is actually goes into what's called cash value. This buys a small death benefit. The small death benefit is small relative to what the base of the contract will purchase for you. But the trade-off here is that I have access to cash immediately. So in this example, I can put up to $30,000 that shows up directly in cash value. So what's my total premium for this? $40,000 a year. Now, that's a lot of money to be spending on a death benefit. The reason this makes sense is that that extra $30,000 is an option that I can put in if I choose to, that the insurance company will then allow me to leverage back out. Now, the first year a policy is in force, you also have an extra unique ability to do what's called a dump in. And I can go total 9 times my base. So if my base is 10,000 and I have 30,000 of PUAs, I can put another $60,000 in what's called a first year dump in of paid up additions. So what does this look like? At the end of the day, I will have a $2.5 million death benefit, knowing that if something happens to me, my family is going to get $2.5 million tax-free if I die. I also have around $85,000 in cash value that's available immediately to use. That $85,000, I can surrender that money and go use it. Or if you understand real estate, we understand the idea of leverage. I can borrow against a house and go use the bank's money to go buy the house. Same thing here. The insurance company already owes me $2.5 million to my family when I'm gone. So I can leverage the death benefit up to the amount of cash value, in this example, $85,000 first year. So if I want to go buy a house, think about this. If I want to go buy a house, here's me. I make income, and this goes into a bank. And then down here, I want to go buy a home. I then can use my cash to go pay for the down payment. And then I have a bank give me a mortgage for 80% to buy the rest of the house. Now, if it makes sense to utilize the bank's money for the mortgage, why then wouldn't I do the same darn thing with the down payment? Instead of using my cash that'll be gone forever if I put it into the house, I can borrow against the life insurance for the down payment. So instead of using a bank to fund this, I put money into my life insurance that will go towards a really big death benefit for the fam. Inside, I have what's called cash value. I can borrow against the life insurance and use cash value as the down payment. Why is this important? Because my dollars inside of life insurance buys me tons of other benefits like long-term care benefits, death benefits, that sort of thing. The insurance company will not recognize the money coming out of the life insurance to go buy the mortgage, and they're going to continue to pay me dividends on the money that I take out. So if I use the cash value, if I call the insurance company and say, hey, I want to borrow, let's say $20,000. The insurance company won't recognize the $20,000. And so that means they will continue to pay dividends on the gross amount, even though the money is out working for me inside of another investment. Now, this is the great principle. It's called OPM, other people's money. And if you're in real estate, you understand how this works. Even crypto, you can leverage other people's money in crypto if you set it up correctly. So other people's money allows me to buy assets that generate cash flow that go right back into my world, paid for by someone else, other people that rent out my house. So I've leveraged other people's money to buy an asset. To buy an asset then that will pay me cash flow. And I have none of my money invested in that. So once we understand how to use other people's money, the question is, how can I set it up so that I can leverage other people's money in any economy? Here's what's crazy about life insurance. Life insurance grows regardless of what the stock market's doing. Life insurance is one of the only assets that I know of that I can borrow against, where the underlying asset that I'm borrowing against is guaranteed to grow even when I take money out. So I leverage the life insurance cash value to go buy a house. Now I can buy multiple assets. All the while, my family has a massive death benefit in the background, so that I actually have permission now to go take more risk because the family's going to be taken care of. Now, when you look at how a policy is set up, the base is going to pay large dividends. This PUA is going to pay smaller dividends. The trade-off is that PUA is available in cash immediately. In this example, like $85,000 is available immediately. Moving forward, next year, I can't put $100,000 in. I can only put in the base and the PUA if I choose. So moving forward, it's only $40,000 a year. I can put in as little as 10 or as much as 40,000 a year for the rest of my life. Let me go over example. Any questions here so far? Go ahead and type it into the chat window. If not, I'm going to keep going. So let's look at an example. This is a basic illustration for a 40-year-old. A lot of numbers here. Let me explain what this means. We'll start on the left-hand side. The year, the policy, how many years the policy is in force. This is for a 40-year-old. So after 1 year, you're 41, 42, so on, goes all the way down. This goes to age 65 in this example. You can see where I put money in the first year, my premium is $100,000. It bought me almost $2.5 million of death benefit. And my cash value is $84,487. So immediately, if I want to go buy a house, instead of just putting money into the house, I can put the money into an insurance contract, get a really big death benefit, have guaranteed growth forever, call the insurance company and say, hey, send me my $84,000 back. Then the $84,000 goes to invest in the house. And the house then will give me cash flow, which I can then put back into the policy. And we do this over and over again. So when we talk about cash flow, you know, a lot of people are saving for retirement or saving for this event that they hope to get to, where they can stop working. And I think they're focused on the wrong thing. They're trying to build a big account value, without actually calculating what kind of cash flow is this going to produce for me. In this example, I'm leveraging a death benefit for the rest of my life for the family. I have cash value that goes up every single year that I can leverage before retirement. Now think about this. Year 2, you want to put $40,000 in? What's the cash growth of your cash value? It's almost exactly what you're putting in. It's almost growing by $40,000. Where's the cost of insurance? These policies are wonderful. Now I'm creating a bank outside of the banking system. So when I look at a bank, you know, my money is exposed to lawsuits. I get very little to no rate of return. And there's no other benefits. There's no death benefit. There's no waiver. There's no riders inside of my cash. If the cash then sits inside of the life insurance, I can leverage it just like a bank, but the insurance company won't recognize me taking the money out. Now, when people say, well, Matt, look, this is 40 grand a year, that's a lot of money. Okay, well then don't put in 40,000. If you want to put in less, you can. But once we realize that my $40,000 premium turns into $40,000 in cash value, I start to realize I don't want money tied up inside of some bank that's earning next to nothing, that's exposed in lawsuits. I have the ability now to take care of my family with a death benefit and then leverage this cash value for anything that I see fit. So as a life insurance advisor, I don't have to apologize to my clients for their account values going down. They can't go down. Instead, I can show you how to create an account to leverage for whatever you want, whether it's real estate, crypto, stocks, your friend's business, whatever it is. You have permission then to leverage that cash value for anything that you want, where you can then go chase a higher rate of return. And when I talk to people in their 40s, you should be doing that. I should be taking advantage of the cash value and not just letting it sit there and getting such a slow rate of return. Remember the old saying, the tortoise and the hare. The tortoise was just slow and methodical in the race, and the hare sprinted and then fell asleep, and the tortoise ended up winning. This is the tortoise. It's the foundation of what I'm going to do with my money, because it guarantees a death benefit when I'm gone, has nice, slow, consistent growth, tax-free, and I can leverage it anytime that I choose for what I want to do, for whatever I see fit. Now, when I take money out of this, let's say year 4, I have $200,000 in cash value. This is how simple it is. I call the insurance company and say, I'd like to take money out of my cash value. They say, do you want to surrender it or do you want to borrow it? And I get to choose how to access that money. And if you know anything about insurance, depending on what's happening in the economy, it usually makes sense to borrow against the cash value rather than just take the money out. Because when I borrow against it, the insurance company continues to pay the dividend as if the money's still in the policy. So I can borrow against the cash value. I'll take $200,000 out. They send me a check or direct deposit, which within like 5 to 7 business days. And the insurance company won't recognize that loan. Now, when I have a loan, a lot of people think of banks. So let's talk about life insurance loans really quick. A loan at the bank. Who determines the interest rate? The bank does. If you want a secret the secret to getting a low interest rate on a loan is to prove you don't need the money. So if I take a loan from my life insurance, I will pay an interest rate to the insurance company. And the insurance company will dictate what that is. Usually it's around 4, maybe 5%. Now, when I have a loan at the bank, I have what's called debt service. I have monthly payments back to the bank. They do a credit check. They check your debt to income ratio. You get a mark on your credit report. You can't borrow too much because it's based on your income. So there's all these hoops we have to jump through when I borrow money at a bank. And one of my favorite, or one of the most important things to realize is that they want their money back consistently. And if I don't make monthly payments back to the bank, they can come and take that asset. Like if I don't make my car payments, they can come and take the car. Well, the insurance company is totally different. They've already put a $2.5 million death benefit in force. They owe that to my family. So if I borrow money from against my life insurance, I have no debt service. Check this out. In this example, let's say in year 4, if I took out $200,000 and I went and bought a house down the street, and let's say 6 months later I die, my family would get $2.485 million minus the $200,000 that I already took out. So they would get around 2.285 in death benefit plus the house that I just bought down the street. So I'm leveraging my future benefit to my heirs, borrowing against their inheritance to go buy more investment stuff before I go to retire. So in other words, this insurance company does not care if I have the loan outstanding. They're just going to take it off the death benefit when I die. In other words, I have no debt service. I don't have to make payments back. There's interest in the background. I don't even have to pay the interest payments. Those interest payments will come off of the millions of dollars when I'm dead. Now, I'm 40 years old, almost, and I want to put money into a policy, take it back out, and go buy stuff, put money in, take it back out. And I'm constantly putting money in and out of these contracts. So I want to repay my loans because I want to be able to buy more and more stuff. When I go to retire, I'm going to live on those assets. I'm going to borrow against that future death benefit forever. And everybody knows debt is tax-free. So I'm living on tax-free cash flow from an asset that I leveraged multiple times before I actually got to retirement. When I take a loan from the life insurance, there is no credit check. No credit check. There's no reporting. I'm just borrowing against my own asset. The government doesn't know it exists. Banks don't have to know that it exists. The credit agencies don't know that it exists. I just have access to cash. Now, in the last 12 years, we've seen a really good bull market. The market's done very well. Until this year, it's starting to get a little more rocky. Life insurance does not go down. Okay. So as the market's getting more and more volatile, it's the perfect opportunity then to have access to cash so that I can do whatever I want. When I start a policy, that policy is going to grow guaranteed forever. And when the market drops, I have buying power when everybody else is hurting. So in the early part of the year, when the market dropped and everyone's looking at their 401k and their retirement accounts and, they're down 15, 20%, my life insurance didn't lose anything. In fact, I can go buy some of those assets that just dropped in value. And if you like to play the market, like day trading, things like that, everyone knows the value of having cash when everybody else is running for the hills. So borrowing against it, I have none of this stuff that a bank requires. And I've set up a policy for myself, for the family, of $2.5 million of death benefit. One other example here. If I want to make an investment in something else and they're going to say, fill out a net worth or a financial statement, my cash value goes towards my net worth. Banks will allow you to post your cash value as collateral, and they'll lend against that collateral. So like I said, if you prove you don't need the money, you can negotiate a smaller interest rate. Now, this is between you and your bank, but if I have 100 grand and I go to the bank and say, hey, look, I want to go buy a house. I have 100 grand, but I don't want to use my money. I'll pledge it to you. So if I default, you get the $100,000. It's called a collateral assignment. The bank has no risk in the transaction, which means their interest rate will be reduced. And you can negotiate a 1 or 2% interest rate because you've backed the loan with cash that they can use as collateral. And let's go over these numbers here really quick too. You can see starting in like year 5, your $40,000 is turning into more than $40,000 in cash value. After 10 years, you've put in around 400,000 plus an extra 60, so about 460,000, and your cash value is $500,000. Now, is this guaranteed? No, there's all sorts of columns you got to look at. Everyone's going to be different based on age and health. But someone can say, $40,000 a year is saving. That's a lot. It is. And you're used to putting money into an account and then doing this, hoping that the value is going to go up. Completely different mindset. This is, I have 40 grand in the bank, earning next to nothing, exposed if I get sued. Why wouldn't I want to put $40,000 in cash into a policy so that I can get, what's 440 to 498? $54,000 in cash value. I turned 40 grand into $54,000 with no market risk, no tax. You're not paying the advisor a fee to manage it. And I can take the cash out to go leverage. So in the next couple of videos, I'm going to show you how to pull money out, how to fund, how the funding of the 40,000 going in can be varied, but how to leverage the money being pulled out. So to go buy a car, send your kids to college, and ultimately to retire at some point. So at the age of 65, you can see down here, I have all of this cash value, and look, this is growing by almost 100,000 a year. I can start pulling out like $100,000 a year tax-free in retirement from an asset that I've leveraged 100 times before I even got to retirement. So retirement planning isn't just putting money into an account and hoping you get there, hoping the market goes up, and then just waiting magically till you're 65 and then get out of bed and say, okay, I'm going to retire. You have to understand how cash flow works. So in the next few videos, I'm going to talk about how to put money in, pull it right back out, and then the net result, because I can pull money in and out of these accounts every single year. It will not offset how much cash value I have in retirement, because the insurance company does not recognize me taking those loans, and they're going to continue that account growth, even though the money's in my pocket and in some other investment. Royal, I got a question here. Would this be called universal index life insurance policy or a customized universal policy, something like that? Yeah, yes, kind of. Let's talk about this first. So indexed universal life insurance. Man, I should really do a quick video on that whole thing. How much time do you have, Royal? You got another 15 minutes?
Yeah, my Mondays are pretty solid, so I don't really have too much going on.
Okay, cool. So there's a difference between universal and whole life insurance. And universal can be indexed, like tied to an index, or it's called variable, which you can actually own different stocks inside the policy. Now, before I dive into this, I want to give you a little bit of history as to why these policies were designed. In the late 70s, interest rates were really high. Inflation was going crazy, and whole life insurance dividends do not react to the market. They do, but it's much slower, like on an annual basis, and it's always delayed. It's almost boring. So people were dropping their whole life insurance to then go buy a bond that was paying 7%. So the insurance company said, look, we'll let you chase the rate of return. If you want to chase the rate of return, we'll let you do it. However, we're going to put the risk on you. So we're going to create a whole new product called universal life insurance, where the growth is tied to an index or stock. So there's universal, which is totally different than the whole life insurance. So here's my example. Let's say you have a bucket and you have water, and you're dumping water into this bucket. Okay. If you're trying to fill the bucket and there's a hole, you have a negative that's hurting your ability to fill up the bucket. Okay. So if you consider the bucket the universal life insurance and the water is your cash value, it looks really good, but you can't see the hole in the back of the bucket. So as you're putting water in other words, premium, you're funding a policy, putting premiums in, you don't realize that there's water leaking on the back. This comes out in the form of fees, surrender charges, and what's called cost of insurance. The insurance company reserves the right to change your cost of insurance forever. And as you get older, I mean, what the likelihood of death as you get older increases substantially. So the cost of the coverage goes through the roof. So for younger years, it looks really good because you have all this water or all that cash value. But as you get older, this hole just becomes massive, and it just erodes all of the cash value. So you can use universal insurance, but when it comes to cash flow banking, it doesn't work as well. Personally, I like whole life because I can leverage it as a bank and not offset the growth. And I have no risk. Like if I want to go buy the index, I'll just take money out of my whole life insurance to go buy the index. Hell, some insurance companies allow the dividend, which is what insurance whole life works. The dividend can be tied to an index without all the risk. So universal insurance, the design of a policy is completely different than whole life. Whole life is like boring, dude. It just grows nice and slow. And here's how the growth is. So here I have what's called interest, which creates my growth. So as the index goes up or as my stocks go up, I'm going to earn interest inside my policy. Whole life insurance is different. My growth inside of whole life is tied to the profitability of the insurance company. So if you've ever heard of the word dividend, a dividend is shared profit. So as the insurance company makes money, they give me a portion of their shared profit in the form of that dividend, which is much more consistent over time than an index fund, because the index can go down and up. People who sell universal or index policies talk about how there's a floor of 0. It's not accurate, because there's still this hole of all these fees that come out. So they'll say if the index is -20, you're going to have a floor of 0. But they don't tell you, oh, by the way, you're still going to have fees, surrender charges, and cost of insurance coming out of that. Whereas whole life insurance, it's a nice boring dividend. Dividend rates don't change much. They'll change once a year if they do. And it might go from like 6 to 6.2 or 6 to 5.8. It's not a very, it doesn't do this by any means. It's just nice and consistent. So universal is not a bad policy. It can be used for, I see it used more for estate planning purposes, and some young people who don't really understand leverage yet, but they can tie the growth to the market, which they think is the great thing. I'm not a huge fan, because I like putting money in and then pulling it out to go buy stuff that's going to give me a heck of a lot better rate of return than just an index fund. Does that help? Cool. You also asked, how can I set this up using a trust for a micronation? I don't know what a micronation is. What's that?
Essentially, a micronation is someone who is sovereign from U.S. So meaning my actual house or land where I'm at is actually out of United States jurisdiction. So it's like having a mini country inside of a country, basically. So if you look up the Republic of Malaysia, it's its own country inside of Nevada. So it abides by its own laws, its own currency, still uses US currency, but I have that set up for myself and my family. So I have my own citizens, and I act as a monarch. So
interesting.
Yeah.
That's out of my league, my friend. I've heard of stuff like that. I don't know anything about it, dude. So what I do know, there's a really good book that I would recommend to anybody if they're interested in what you're talking about. And because another way of saying that is I want to keep my money away from the hands of Wall Street and the government legally, right? I want to do this legally. So insurance is a great way to do that. So the way that I understand it with my clients is, yes, we do use trusts. There's a book that you could read. It's called What Would the Rockefellers Do? And it's all about, the parallel is he talks about Carnegie. No, Vanderbilt. I always get the two mixed up. Vanderbilt, who at one point had more money than the U.S. Treasury. His 4th grandson died broke. How do you do that? Because they didn't understand how wealth worked. And then he compares it to the Rockefellers, who give away $50 million a year to charity, have hundreds of people who live off of the trust that just get a check every year. They use it. They do it by creating life insurance policies for everyone that's born, as much as they can buy, putting as much money as they can inside the policies. And then they have a trust structure in the background that keeps that wealth out of their estate. It's inside of a trust. So you can avoid this. Again, this isn't, I would talk to an attorney on this, but you can ideally avoid income tax and avoid estate tax if these policies are inside of a trust. The trade-off is access. You have to have a trustee and then someone allow you to get money in and out of that policy. But it's a great way to do it. As far as the nation thing, I don't know about that, but trusts are always, not always, trusts are very commonly used when it comes to life insurance. Because we have the ability to increase our net worth and our family's inheritance millions. And we want to make sure that it goes to my family, not to some attorney or to the IRS unnecessarily. So good question. Yeah, I don't know anything about micronations. I've talked to a lot of people all over the country, and some people are big into that. And, some people talk about how taxes are avoidable, it's unconstitutional. And I just kind of stay away from it. So, yep, there's the policy that I would use for a 40-year-old. This is what we set up for people all day. So unless anybody else has any other questions, that's pretty much all I got for you.
That book you recommended about what Rockefellers do, is that similar to, I think I read it, but I read a book called What Will Billionaires Do? Is that along the same lines?
It is, and there's a joke
Oh,
in there because Garrett, the author, got contacted by the Rockefellers, and it was like, we don't care if you use our name, but he did something wrong, and it was kind of funny, so he changed it to billionaires. So yeah, same thing, same book.
now, also with the policy, with the whole life that you just explained, I'm assuming there is a, let's just say how you had this annual premium of 100,000, but then next year was 40,000. That 40,000, would there be like a limit, like what do you call it, the modified endowment contract period to avoid that tax? So like if someone wanted to put in an extra 10 grand off of that 40K premium, would they be able to do it or no?
No, sir, they cannot. So in this example, the max is that 40 grand premium. So we can always do less than the 40, cannot exceed 40. The insurance company will actually reach out and say, hey, you can't do that. It's going to mech the policy, which is an acronym for what you just said, and triggers taxation. So the insurance companies know that. It very rarely happens. It's almost very difficult to turn it into a mech. So in the instance where I make more money and as I get older, I just buy another policy. So I'll start a whole new contract. Like I have 3 contracts. My first one was when I was like 22 years old, 2,400 bucks a year. But now the thing's like 15, 16 years old. When I put in 2,400, it's growing by 4 grand. I mean, it's the best rate of return that I have. So as I got older and made more money, I would buy more and more policies, and just to leverage them the same way. This is the first point, is like, if I look at the hierarchy of decision-making when it comes to making money, I got a family. I want to take care of the family. Money goes into a policy as much as I can, and then I take it right back out to go buy stuff that'll give me cash flow.
Got you. And another question would be is, let's just say that I'm trying to cut the actual age curve and get into the fast lane. So for example, I noticed, a lot of people, if you ever heard the story of penny doubled every day until 65, will get you trillions of dollars, so to speak. So since the age thing, so let's just say me being my age, I'm age 30, right? So I want to be able to, will I be able to cut 30 years off of, of, of growth, meaning to accelerate it, meaning would I have to choose what I want my policy to be? Let's say I want to dump to start off, 200K into my policy. Will that be something that can be done, or how does that actually broken down,
Yeah. Yeah. So one thing to answer your question, guys, I think what you're going for, the biggest problem with money is that people don't have enough. How do I make more? How do I make my pile double or triple or quadruple? Like that's the number one problem that people have. So the way to get around that is not to take more risk to double the account value, but it's to have assets that spend as if I did have a larger account. Okay. That's the first thought, as you're saying. So instead of like, I got to get to 10 million. Well, what if you had 5 million in the right place? Okay. That's the first thought, because and the reason I say that, dude, is because this 1.6 million in cash value is going to spend like you have 3.5 to 4 million inside of a 401k. Okay. So that's why I say that. In your example, yeah, dude, I would do, your base then would be 20,000. So that would be the base contract. You would do a $60,000 PUA, which is optional each year. And then whatever's left over up to the 120,000 would go straight to cash value. I think like 95% goes directly into cash value. So in this example, your first year would be a $200,000 policy. And then your base is 20 grand a year. Now what would happen up here, dude? This is the part that's cool. Now you're 30, which your numbers look even more attractive because you're younger. But if you just say you're 40, like in this example, double everything. That's how simple it is. I put in twice as much, I get twice as much money, twice as much death benefit. So it would buy like a $5 million face amount up front. Down here, it'd be worth about 6 million in death benefit. And then that number would be double as well. So about 3.2 million in cash value. The more money I can put in early on, the better off. The challenge that people have is, well, what if I can't do it each year? And that's what I'm going to talk about in some other videos, but just know now that it's super flexible. If you don't want to do it, you don't have to put money in.
Gotcha. Another question would be, how would we go about, let's say, like we know someone in the family that has, it's about their time to go, not like as far as like they're in any bad shape, but like, for example, a friend of mine came to me about life insurance as well. He's like, hey, look, our grandma is like 75 years old. She's in great condition. Like, how would someone go about setting up a policy with that age, bracket, just to be like, oh, okay, we know for a fact one day obviously she's going to pass. How can we get $1 million or $2 million real quick, just because we know, or what that policy will look like past that 65 age.
Yeah. So the first thing is to not word it like that.
Right. Just give an example.
But there's another book you can check out too. It's called Wealth and Wisdom. And the guy talks about how to buy insurance on your parents and grandparents. Big red flag. Insurance companies hate the idea. And you can understand why. They're losing money in that transaction. Okay. So you have to have an insurable interest before you set it up. Now you can always make a case. Grandma's living at our house. We have a lot of medical bills. We want to be able to recapture everything that we're investing. We need to put, 700,000 in death benefit. Insurance company will say, sure. You just have to make a good case that's appropriate where there's what's called an insurable interest on grandma and grandpa. If you say, I want to benefit $1 million when she croaks, yeah, you're going to get denied in a heartbeat.
I got another question too. And this may be like an out of ordinary question, but nothing to do with, not trying to pull a race card or anything. Do you feel like that, because like my goal, what I do, I work with individuals in the Riverside community here in Indianapolis. So we work on like a lot of equitable housing and trying to educate, anybody. It can be, white, black, green, blue, but most likely in our neighborhood is more of, people of color, indigenous folks. So we've experienced a lot of things that go on obviously in the U.S. territory with a lot of violence and things of that nature. Do you feel like, or what would be your idea or opinion, if you felt like more people had life insurance policies, do you think more of like wrongful deaths will be happening when it comes to like policy enforcers and things like that? Just because, do you think that these insurance policy companies would, I guess, they will want to pay or wouldn't want to pay out, or I guess what I'm trying to say is that, do you think that if someone wrongfully happened, let's say from a police officer to an individual, do these insurance companies hold those private entities, as far as like polices or anything, held accountable for that? Like, let's say like somebody died wrongful death from a police officer or something like that. Do these insurance companies hold those account, like hire the best investigators or anybody to, for that?
No. So, when I have car insurance, I might not ever make a claim, but I've lost money to the insurance company. The joke is, in life, the only thing that's guaranteed is taxes and death.
Right. Yeah.
So if I die, I die, regardless of how it happens. Now that there's some asterisks there. If I'm going to war or if I'm in the Army Reserves, they're not going to give me insurance. If I'm sick or unhealthy, I'm not going to get insurance. If there's what's called a 2-year contestability period. If I say, I don't smoke on the application, and then 6 months later I die of lung cancer, the insurance company is going to investigate that and say, you lied on the application, we're not going to pay out.
Right.
If a police officer shoots me dead, I'm dead. There's no challenge there. So you have what's called a 2-year incontestability period. So for 2 years, the insurance company reserves the right to create an investigation. Now, if something happens from, wrongful death kind of thing, then that's not like I lied on the application. The insurance company should still pay out. After 2 years, if I commit suicide, the insurance company has to pay out. And I know where it has. I know someone who did that. They killed themselves and left like $7 million to his wife. They paid it all.
Wow.
Not a good financial strategy, though. I wouldn't recommend that to anybody. But
Yeah, man,
I think financial education as a whole, Royal, doesn't exist. You know, I saw a thing when they were doing Kevin Hart with Chase Bank and they wanted to educate the community kind of thing on how money works. And I'm thinking, you're learning from a bank who go to any big city and look at the top of the buildings, and there'll be at least a few of those buildings with a bank name on top. They make money for a reason. And what I'm trying to do is to teach people how to get rid of banks, coming from an objective perspective of here's how you can set your estate up and your finances so that you're in control and you're not losing it to banking, Wall Street, or the government. So I think as a whole, there's a massive need for that. But I think there's some problems there too. The question is, who does someone want to learn from? Because you have guys like Dave Ramsey and Susie Orman that do the radio shows. They don't even give good advice a lot of the time. You know, it's all about how to get out of debt. It's kind of good advice because, 70% of Americans spend more money than they make. That is like they need Dave Ramsey. They got to learn that they're doing it wrong. But when it comes to creating wealth, there's so many ways to do it. And millionaires and billionaires aren't going to slow down and show people. But the foundational stuff that everybody should be paying attention to is life insurance and trusts. That's like the first thing. From there, now I have a ticket to get creative on how I'm going to actually double and triple my money.
got you. And depending on the year, or I guess the insurance company, when you build that cash value, how long to basically for you to take those funds out? Like, is there like a nesting period, meaning you got 5 years before you can actually start pulling from, the equity, or is it just like starting year one?
Great question, dude. And that's why I love this. And this is what I'm showing on the screen. I have access to $85,000 within 30 days. So the money has to go in and, clears your account, that kind of stuff. So it'll probably be 3-4 weeks. And then the money's available to pull out.
And this is just assuming that annual premium of 100K. Is that 100K like the cash that they deposit up front, or?
Yeah.
Oh,
So I'd
okay.
put 100 grand in, I'd buy a big death benefit, and I have access to 85,000 in cash immediately. 15 of it went to the death benefit. And then every year in this example, every year after 40 grand going in, it's grown by almost $40,000, like right away.
Yeah, man, this is crazy. I enjoy it, man. I was reading that book, man. It just made sense. It just opened up my intellect about a whole lot of things of how I actually utilize banking. Because I moved out of using traditional banks. Unless I have to, I use it just to move money around. But most of my capital I use in the crypto space. So I've just been trying to figure out how to create my own ecosystem, so to speak, and everything, most of it into my the policy. So yeah, man, this is good stuff.
Cool, man. Yeah, absolutely. I appreciate you coming on and asking questions and the engagement. I love crypto. I hate how it goes down. That's the part that sucks. So my insurance is my first move, and then I get creative from there. I have a little bit of crypto, but quite frankly, I just don't like it, dude. I like tangible things that I can see, and but it is what it is. The easy play is the life insurance, and then it's fun because you get together with all these clients, and then they're talking about what they're doing, whether it's crypto plays or the metaverse, right? Like digital real estate kind of stuff, or real estate with housing. I mean, I got a really big project this year. We're doing a short-term rental development. I don't know, 15 different townhouses that are all being developed for short-term rentals. So the intention is to just Airbnb them forever. And we already have 20% equity from when we purchased the land and the project, what it was evaluated at. It's already up 20% just from, and they haven't even opened the doors yet. So that's going to be fun as hell.
Yeah, you're on the right track.
Cool. All right, everybody.